Something strange is happening to the American housing market in 2026. There are more homes for sale, mortgage rates have come down from their highest levels. In some parts of the country, asking prices are even falling. So here's the question millions of Americans are asking right now. If all of that is happening, why does buying a house still feel almost impossible? For years, Americans were told that if they could just wait long enough, housing would eventually become affordable again. But what if that's not how this story ends? Because the problem in 2026 isn't simply that there aren't enough houses. The problem is that there aren't enough houses that ordinary Americans can actually afford. And once you understand what's happening underneath the headlines, the entire housing market starts to look very different. So today we're breaking down why buying a home in America has become so difficult, what's happening to prices and mortgage rates, and whether buyers should actually wait for a crash or start looking now. And if you want more stories about the money problems affecting everyday Americans, make sure you subscribe. Let's start with the biggest number in the room: mortgage rates. A few years ago, Americans were living in an entirely different housing world. During the pandemic, 30-year mortgage rates dropped to historic lows. Millions of homeowners locked in mortgages around 3%, and some even managed to get rates below that. 3% for a 30-year mortgage. It was incredibly cheap money. But then inflation exploded. Interest rates went up. Mortgage rates followed. And the housing market changed almost overnight. By 2026, mortgage rates had fallen from their recent highs, but they were still sitting around the low 6% range. Realtor.com's mid-year forecast put the average 2026 mortgage rate at roughly 6.3%. And that difference matters. A mortgage around 3% and a mortgage around 6% can produce a dramatically different monthly payment, even if you're buying the exact same house. But here's where things get weird. You might think that when mortgage rates rise, home prices should collapse. After all, if buyers can't afford the monthly payment, sellers should eventually be forced to lower their prices, right? Except that's not exactly what happened. Instead, something much stranger happened. Home sales collapsed, but home prices refused to collapse with them. Realtor.com estimates that existing home sales fell from a seasonally adjusted annual rate of 6.43 million in January 2022 to just 3.91 million in January 2026. That's an enormous decline, almost 40%. Millions of potential buyers basically disappeared from the market. But home prices didn't crash in the way many people expected. So where did everyone go? A lot of them simply stopped buying. And at the same time, millions of homeowners stopped selling. And that's where we get to one of the most important concepts in today's housing market: the ** mortgage rate lock-in effect. Imagine you bought your house several years ago. Maybe you paid $350,000, and you managed to lock in a mortgage at around 3%. Now fast forward to 2026. Your family has grown. You want a bigger house. Maybe you've even found one you love. But to move, you have to sell your current home and take out a new mortgage. And suddenly that new mortgage could carry a rate around twice what you're currently paying. So you look at the numbers and you think, why would I do that? Your current mortgage is cheap. Your new mortgage is expensive. So you stay where you are. And millions of homeowners are making some version of that decision. That means fewer existing homes are being put up for sale. And that creates a bizarre situation. There are fewer buyers, but there also aren't enough sellers. So instead of getting a massive housing crash, America gets something much slower and more complicated. A market where transactions fall dramatically while prices remain surprisingly stubborn. But now we're seeing another major shift. Inventory is finally improving. In June 2026, Realtor.com reported more than 1.1 million active listings nationwide. That's an improvement. Buyers have more options than they did during the worst part of the pandemic housing shortage. But here's the catch. Having more homes for sale doesn't necessarily mean having more ** affordable ** homes. And this may be the biggest misunderstanding about the 2026 housing market. You can open a real estate app and see thousands of properties. You might think, finally, there are houses everywhere, but then you start filtering by price. And suddenly that giant list gets a whole lot smaller, because many of the homes being offered are simply outside the financial reach of ordinary households. A recent analysis from the National Association of Realtors Registered and Realtor.com highlighted exactly this problem. In March 2026, their national listing income alignment score was 74.9%. Before the pandemic, that figure was around 84.4%. In simple terms, the homes being listed today don't match household incomes nearly as well as they used to. And middle-income buyers are getting hit particularly hard. Households earning around $75,000 a year could afford only about 23% of listings nationwide. In a much more balanced market, that figure would be closer to 44%. That's an enormous difference, and it explains something that many people don't understand. You can have more inventory without actually having more affordable housing. Imagine you're earning $75,000 a year. You open your phone, you start looking at houses, and you see a beautiful property listed for $450,000. It has the bedrooms you want. The neighborhood looks great. The kitchen is perfect. For a moment, you think, maybe I can make this work. Then you calculate the mortgage, then property taxes, then homeowners insurance, then maintenance, then closing costs, and suddenly that beautiful house doesn't look quite so beautiful anymore. It looks like a 30-year financial commitment hanging over your head. And there's another cost that buyers increasingly have to think about: insurance. In some parts of America, homeowners insurance has become a major affordability problem. That's one reason the National Association of Realtors Registered has been examining affordability measures that account for insurance costs. Because the traditional calculation, home price plus mortgage rate, doesn't tell the entire story anymore. You can have a house with a slightly lower price, but if insurance, taxes, and other ownership costs are rising, the monthly payment can still be painful. And that's why one of the biggest traps in today's market is looking only at the sticker price. Someone might tell you, home prices are finally falling, but that doesn't automatically mean homes have become affordable. A $400,000 house with a very low mortgage rate can sometimes be easier to afford than a significantly cheaper house financed at a much higher rate. The price matters, but the cost of borrowing that money matters too. And there's another reason you can't simply look at one national number and understand the entire housing market. America doesn't really have one housing market anymore. It has hundreds of local markets behaving in completely different ways. Realtor.com's June data showed that asking prices since the national peak in June 2022 had fallen in the West and South, while prices had actually increased in the Midwest and Northeast. Think about that. A buyer in Texas could be experiencing one housing market. A buyer in New York could be experiencing something completely different. Someone in Florida could be seeing price cuts and more inventory. Someone somewhere else could still be competing for a limited number of homes. So whenever you hear someone say, home prices are falling, there's one question you should immediately ask: where? Because location can change everything. Now here's where the story gets a little more interesting. There are actually some signs that buyers may finally be getting a little breathing room. Realtor.com's July 2026 mid-year forecast expected existing home prices to rise only about 1.2% for the year. That's slower than its earlier forecast of 2.2%. Existing home sales were also expected to reach around 4.1 million, with activity improving during the second half of the year. That's not what a housing crash looks like, but it could be something else. A market slowly becoming more balanced. And for buyers, balance can be extremely valuable. Because when you're not competing against 10 other buyers for the same house, you have options. You can take your time. You can negotiate. You can ask the seller to make repairs. You can potentially negotiate closing costs. You can walk away. And that's very different from what buyers experienced during the housing frenzy of 2020 and 2021. We're already seeing signs of that shift. Realtor.com's June data showed national asking prices down 2.5% year over year, the 8th consecutive month of declines. At the same time, new listings were increasing and pending sales had risen for 7 consecutive months. So the market isn't frozen anymore. But there's still one giant obstacle standing between buyers and homes: interest rates. In late July, mortgage applications dropped as higher rates discouraged buyers. The Mortgage Bankers Association reported that its purchase index fell 4% for the week ending July 24, while the overall mortgage application index dropped 6.4%. And this tells us something extremely important. Americans aren't just watching home prices. They're watching the monthly payment, because that's what determines whether someone can actually live with the mortgage for the next 30 years. And that brings us to the big question: what happens next? There are several possibilities. The first is that mortgage rates gradually fall. If that happens, buyers could come rushing back. But there's an interesting twist. Remember all those homeowners sitting on ultra-cheap mortgages? If rates fall far enough, some of them might finally decide, okay, now I can move. That would put more homes on the market. But cheaper mortgages could also bring more buyers back at the same time. So falling rates could increase both supply and demand. The second possibility is that rates stay high. If that happens, buyers may continue waiting. Sales could remain relatively weak, and sellers may gradually become more realistic about their asking prices. That could lead to something much less dramatic than a crash. A slow adjustment, month after month, year after year. And then there's the scenario everyone loves to talk about, the housing crash. But here's the uncomfortable part. Expensive homes don't automatically mean another 2008 is coming. The housing market in 2026 is very different from the conditions that helped create the financial crisis of 2008. The bigger problem today isn't necessarily millions of homeowners suddenly being unable to pay their mortgages. It's affordability, it's interest rates, it's limited inventory. It's homeowners refusing to give up cheap mortgages, and it's a shortage of homes at prices ordinary Americans can actually handle. That's a completely different problem, and it means waiting for a massive crash may not be the perfect strategy. Because if you're waiting for home prices to fall 30 or 40%, you could be waiting for something that may never happen. The market could instead slowly become more affordable through a combination of slower price growth, rising incomes, more construction, more inventory, and eventually lower mortgage rates. And that brings us to what may be the biggest issue of all. America doesn't simply need more houses. It needs more affordable houses. That's the real mismatch. There are homes, there are buyers, there is money, but they're not lining up. And until they do, millions of Americans are going to continue feeling like homeownership is moving further away, even when the headlines say the housing market is improving. So is 2026 a terrible year to buy a house? Not necessarily. For some buyers, this could actually be a better environment than the frenzy of a few years ago. There are more listings. Price growth has slowed. Some markets have seen price reductions, and sellers aren't facing the same overwhelming demand they experienced during the pandemic boom. But that doesn't mean everyone should rush out and buy. Because the smartest question isn't, are home prices falling? It's, can I comfortably afford this house? Can you afford the mortgage, the taxes, the insurance, the repairs, the maintenance? And what happens if your income changes? Because buying a home isn't about getting the lowest possible price. It's about being able to live with the payment after the excitement wears off. And that may be the biggest lesson from the American housing market in 2026. The country doesn't necessarily have a shortage of houses. It has a shortage of houses that ordinary Americans can afford. And until that changes, the American dream of homeownership is going to remain frustratingly out of reach for millions of people. So now I want to hear from you. If you were buying a house in America right now, would you buy in 2026? Or would you wait for mortgage rates and home prices to fall? And more importantly, do you think America is heading toward another housing crash? Or are we simply watching the market slowly return to normal? Tell me what you think in the comments. And if you want more stories about the money, housing, and economic changes affecting everyday Americans, subscribe to the channel.